And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It's, of course, hump day as we get this Real Investment Show under the way today. And we actually have our mic on today. Today's actually starting out good. I mean, no glitches right up front. So, yeah, it's all good stuff. We get a lot of emails here over the last couple of days, asking about, sell and may go away, right? And so, obviously big concern. So we're going to talk a little bit about that this morning when we get to our Before the Bell segment. But outside of that, before we get there, we've got a few things coming up this week. Important. We got the employment report on Friday. Saw the JOLTS report yesterday. Kind of mixed. It wasn't really bullish. It wasn't really bearish. Just kind of a mixed outlook on kind of the labor market right now. We're clearly seeing some weakness in the labor market. Full-time job losers are now rising fairly decently, and that's typically kind of what you see before you get into a much slower economic environment. It's just telling you that companies are letting go full-time workers, and they're not temporarily laying them off. They're laying them off for good, right? And so we're seeing a rise in the number of full-time employment losers. And that's not good because full-time employment is what pays the bills, right? So it's hard to raise a family of, 4 people, pay for a house, all that on temporary work or part-time work. So full-time employment is very important, not just from the aspect of providing someone with enough, income to sustain their living standard, but also to support the economy. We need more full-time jobs. So the loss of full-time jobs, certainly concerning, but that hasn't translated yet into, much weaker employment numbers. But we are seeing a weaker trend in the employment data, and I expect this Friday we'll continue to see that working. Now, again, we're not seeing negative prints on employment. So if you're going to get into a recession, you need to start seeing negative prints on employment. You never have a recession without negative employment prints. And that's part of how the NBR, the National Bureau of Economic Research, classifies a recession. Remember, a couple of years ago, we had those 2 quarters of negative economic growth, and everybody's running around. It's like, that's the technical definition of a recession, 2 negative quarters of growth. And the National Bureau of Economic Research came out and said, yes, technically that's true, except you never had negative employment. So it wasn't a recession, and it wasn't. And in fact, when we got the revision, the first quarter was revised up positive. This year, we had a negative quarter in the first quarter. Everybody immediately going, oh my gosh, the recession's here. And we were like, and we said, no, just be careful with this. This is all about the trade deficit. And as we talked about yesterday, there's been a big reversal in the trade deficit now that imports are dropping like a rock because we no longer need to front run tariffs. And so now we're going to have about a 2.3% economic growth in the second quarter. And most likely we'll see that first quarter revised up somewhat in future revisions. So, but again, these anomalies to the data are always important to pay attention to. But when we get down into the statistics, we need some certain things to occur before you can really start worrying about some of these things. So again, it's always important to separate out these headlines. And we have a lot of these headlines out right now that are weighing on investors. I'm getting tons of emails every day about Jamie Dimon said this about the bond market, or Ray Dalio said this about interest rates, or now it's the 899, right? This is a big scary number, the 899, which is Section 899 of the big beautiful bill, which imposes a foreign tax. So now everybody's worried about this because it's going to potentially be a capital war on foreign countries. That's scary, right? I mean, we'll have this capital war with foreign. No, this is first of all, this is likely not going to get passed, in terms of the bill, because it takes away control from the Senate Foreign Relations Committee. It takes control of taxation away from Congress. So there will probably be some, many revisions of this before it comes out. But even if it does come out, it's only expected to raise $12 billion a year in taxes. It's not that big of a deal. But again, great for scary headlines to get people to worry about stuff. So just be careful with these narratives that we've talked about before. The end of U.S. exceptionalism. Money flows are piling into U.S. equities. The whole story about the end of U.S. exceptionalism is hogwash. So just forget that kind of stuff. But again, this is what feeds our biases. We've talked about this previously, our negative psychology. We need that fear. We need that negative headline, right? That's what gets us going in the morning. It's better than coffee. have that negative headline. But again, just don't let it impair your investing because markets are doing just fine. And in fact, let's talk a little bit about a summer swoon. So here's what you need to know before the bell. So the old saying is sell in May, go away, right? And we're going to talk, I have some more data on this that we'll get into in the next segment. But, just looking at the markets, we've had a very, very strong rally, right? So we had this sell-off in April that put a lot of pressure on markets, got markets decently oversold. Sentiment got very, very negative. We had very, very negative sentiment. We have not reversed that sentiment just yet. And we've got a lot of momentum now behind the market. So again, price tends to carry price. So as markets start rallying, you kind of get, it's like a freight train. It's hard to stop. And so when you get this kind of rally going in the market, that's very, very hard to stop that type of a rally and just immediately have a reversal and start selling off. It's like, oh, sell in May, go away. There are certainly some reasons we'll get into that, have historically suggested that returns are lower, but that doesn't mean lower returns are negative returns. And that's the big difference that we need to understand here. Now, technically right now, the markets are doing just fine. We've been doing actually some very bullish kind of work behind the scenes. The market's been trading now in this kind of trading range for really since May the 12th, but we've just been stuck in this consolidation pattern. Now that's good from the standpoint that allows kind of these, kind of some of the other technicals to catch up. We've had moving averages turn up. The 20-day moving average is now back above the 100 and the 200-day moving average. We're seeing this consolidation of support right here. The market's tested the 200-day moving average, held that support, turned that previous resistance into support. So that was bullish. And now we're trading at the top of this range. We haven't really broken out of this just yet, but money flows have now turned positive. And so we've had these money flows turn positive. They kind of tailed off a little bit here when we got that little bit of selling pressure last week. And then, or really week before last. And then since then, this market's been rallying. Money flows have been coming back into the markets. We've seen, a lot of stocks like NVIDIA doing very, very well. Palantir has been doing very, very well. These were the stocks that everybody supposedly hated. Well, now the Mag 7's doing well again. So money's starting to get pulled back in there. And again, a lot of hedge funds, very, very underweight equity. So they've got to get allocated to markets. So that's giving some lift to the markets right now. Also, don't forget, right now we have stock buybacks still in play. Those are in play until mid-month. So we've got a lot of money flows coming into equities, particularly in the areas of companies that have the largest amount of buybacks. So those are benefiting from this right now. So again, a lot of this support here, yes, markets are overbought. We haven't really worked that off, but this consolidation right now is bullish. And again, we're not really going much of anywhere. We are, kind of traveling up and down here a bit. But this consolidation process is actually kind of bullish here for investors. Now, if we break out of this consolidation, this is going to set up a rally to all-time highs for the markets. And a lot of people are like, how's that going to happen? With all this other stuff that's going on. We've got the dollar and worries about tariffs and all these type of things. How's the market going to rally to all-time highs? Markets tend to do exactly what you don't think they should do. And that's the frustrating thing about markets, is that everybody expecting markets to sell off a lot, typically they don't, or vice versa. If you continue to expect them to rally, that's about when they get you. So again, be careful with just expecting the market to do something from a historic basis, because there's really no reason for it to do that. And right now, we've got a lot of momentum. So again, just kind of pay attention to what's happening with the markets. If we do break out here, that's going to be bullish. That's going to push stocks further to the upside. Again, got to manage your portfolio for risk, but don't overestimate this need to sell in May and go away. And when we come back from the break, we'll get more into that. But so if you're watching our Before the Bell short, be sure and go watch our full show this morning on our YouTube channel at realinvestmentadvice.com. But again, we'll get into that. But right now, markets are fine. Backdrop is bullish. Stay invested right now. Forget a lot of these headlines because they're not really that important right now. They may be in the future, not right now, but that's what you need to know before the bell this morning. We'll come back, talk more about a summer swoon with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So getting a lot of emails lately about sell it may go away, and obviously it's of concern because it's an age old. It's actually a couple of centuries old. Goes back to when the financial markets were in London, and everybody would go away for the summer. They go on vacation, they do whatever they're going to do. So markets tend to struggle a little bit in the summers, and so the kind of the Wall Street axiom has been, sell it may go away, and as Brent will show you here, I've got a graphic of this. So just to technically define what sell and may go away is that you sell in the month of May and you come back in November. So you're out for the 6 months of the market from May, June, July, August, September, and October. You come back in November. And then you stay invested 100% of the time from November through the end of April. So that sell and may go away. And statistically, it certainly backs that up. This is just the return of $10,000 invested only during the strongest 6 months of the year versus $10,000 invested in the weakest 6 months of the year. And, you can just walk away right now and say, well, see, obviously just being invested in the summer doesn't really work out. And there's some truth to that. We have our strongest returns. Typically, if you look at the strongest months of the year, they occur in November, December, January, March, and April. Those tend to be the stronger months of the year. And you create a bulk of your returns, of that annualized 7 or 8% return that you get. A bulk of that's created during that 6 month period of the year. But does that mean that every year is a negative year? No, leave that chart up, Brent. There's statistics on it. Does that mean that every year is negative? No, and you can see this right at the top of the chart, which is the number of periods that are advancing from November to April out of the 68 years that we looked at in this particular chart. 49 of them advanced in November through April. 19 were decliners. In other words, you lost money during that period. May to October, 45 out of 67, because we haven't finished the summer yet, so it'll be 68 when we get to November. But 45 out of 67 times, the summer period was up. It's like, well, the majority of the time, the summer's up, so why would I want to be out of the market? Well, that's the whole point. You don't. the idea of being all in or all out of the market is rife with a tremendous number of problems because you won't get back in, when you should. You're out of the market, but the market's going up, so you try to get back in and you buy a peak. You do all the psychologically bad things. The point about sell and may go away is to understand that returns typically are lower in the summer months. The average advance from November to April is 10.46%. The average advance in the summer is 7.62%. You also have more volatility typically in summer months. And again, why are so when you look at the analysis, why are the summer months so weak relative to the winter months? And the reason is because think about what happened over time. There were some very big events. You had 2000, the dot-com crash. You had the financial crisis in September of 2008. You've had a lot of your big events, the crash of 1929, that was in October. So over these times, a lot of these, kind of bigger drawdowns in the markets that were anomalies, they tended to occur in the summer, and that skews those summer returns lower versus the seasonally strong period of the year. So again, it's just, you've got to be careful with these macro kind of comments and these axioms that people kind of latch onto, and understand that market dynamics kind of, operate differently from that. So here's some actual statistics. I went back and ran some statistics. So, we had a very strong May. So what does that mean for June? And as we said during the before the bell, there's a lot of momentum in the markets right now. So that's kind of just pushing markets higher. Everybody's trying to get back in. Everybody that bailed out back in April, they're now trying to figure out how to get back in. Danny was getting a lot of phone calls like, get me out of the market. Well, now those same people are going, how do I get back in? And so you've got a lot of that momentum chasing at the moment. But, when we start looking at kind of some of the historical details, I'm just going to read this to you from our daily market commentary that I put out this morning. Since 1950, the S&P's 500's average returns from May through October have been considerably lower, about a 1 to 2% annualized gain than those. So in other words, 1 to 2% lower than the average of November to April. This disparity is attributed to factors such as lower trading volumes, mid-year economic slowdowns, investors taking summer vacations, etc. However, investors should take sell in May as not rigid as investment advice. Modern dynamics of the markets right now, algorithmic trading, CTAs, all these type of things that are going on, the magnitude of stock buybacks are impacting what happens during summer months, more so than we've seen previously. Historically, June's been one of the weakest months of the year. And Brent, I've got a chart on this for you as well, just so that we can get everybody on the same page. So this is a chart. June's been one of the weakest months for U.S. equity since 1950. The S&P 500's average June stock performance is roughly flat. It's about 0.1% gain on average. Just half of all Junes finished positive. June ranks as the second weakest month for the market. Only September has been worse, and that's also why your summer months tend to be weaker. With an average June return of only 0.06% since 1957, that performance helps explain, part of this dynamic. However, now, again, I want you to be careful with this because recent decades, particularly over the last 2 decades in particular, June isn't always a loser month. The S&P rose in 12 of the past 20 June months, 8 of 10 in the past decade. And one crucial factor is when May's performance is strong. One of the differentiators between the 8 of 10 times that June was strong over the last decade, May was also strong. Again, momentum push into the markets. So again, just the whole point about this, just be careful with this analysis of sell and may go away type thing, because again, it's not meant to be rigid investment advice. Just in the last 5 years, 2021, super strong summer. Markets were just surging on $5,000 checks to households, etc. 2021 summer was strong too. Then of course 2022 the summer was weak because we were in the middle of kind of that whole correction period. 2023 we had the market sell off in the summer because of the whole AI trade, as we were all worried about, the end of the Mag 7 trade, NVIDIA, blah, blah, blah. 2024, we had the yen carry trade blow up. Markets were down 8.5%. So again, just in the last 5 years, you had 2 strong summers, 3 weak summers. What's this year going to look like? I don't know. But this is why we're maintaining a little bit higher level of cash. We are aware that summer tends to have more volatility, weaker rates of return. So we're holding more cash right now. But again, it doesn't mean just be all out of the market, because the hard part is trying to get back in the market when it's time to do so. Good morning, Danny. How are you?
Hey, morning. Good.
Good. Didn't mean to leave you out of that conversation.
No, it was great.
Because Danny's like, well, why am I here this morning?
I may have thought that. No, but you make some really good points. I mean, I think that's the struggle that most people have to deal with, is that you see a little bit of volatility. You think, oh my gosh, we've got to protect. We get into protection mode, and we do it at the wrong times when obviously the market's declined a bit. And then we see things change quickly. But then following these narratives make it even more difficult, because you see this narrative everywhere. Mm-hmm. But you said, what, 46 of last 60 years have been up?
Yep.
Yeah. So
not as much as the other 6 months, but positive.
Correct.
Right.
But that's what everybody gets hung up on, is that one specific narrative. And we see it time and time again, and it'll switch in another month or two. It'll be something completely different than what we're talking about right now. Mm-hmm. And that's just the way the markets go, in a headline-driven environment. And it'll always be headline-driven to some extent. But, with the speed of information, all the different data that we get, the problem is that a lot of this data is going to be revised.
Right. Well, it's just like I was talking about in the opening segment this morning. There's always a headline to worry somebody, and a couple of months ago it was all about tariffs. These tariffs, and now that tariffs are pretty much okay, we already know what these are. They've pretty much all been quailed down a bit. Now it's the 899 section of the tax bill, right, or the big beautiful bill, and then it'll be something else. And if there's nothing else going on, then we come up with narratives like the end of U.S. exceptionalism or whatever. So again, it's just, there's always a reason not to invest, and the market works on that idea. When there's not a reason to invest, that's typically when markets are finding opportunity to invest capital. And I know that seems counterintuitive. Like, why would I want to be invested if the U.S. is losing exceptionalism? Well, that creates value in certain sectors of the markets. And money will gravitate towards that. Money will find what those values are and wherever it is. And then when those assets get really, really overvalued, overbought, that narrative has kind of run its course. Then there'll be a new narrative, and there'll be value in some other space of the market, and money will run over there too. And so whatever was running up gets sold off to go buy whatever else is down. That's just the way markets work over time.
Well, volatility creates money in motion.
Correct.
And so they're seeking and finding that store of greater value, essentially.
Right.
Or the growth aspect.
Well, but that's the important key, right? They, being institutional investment capital, those type of things, they're rotating money. They're not getting out of the market.
Yeah.
Right? They're not hiding in cash, waiting for a shoe to drop. They're looking for opportunity to invest capital where there's money to be made.
Well, that's interesting, because right now we've seen retail investors really be on the other side of the boat than institutional.
Very different this time.
Yeah.
We'll talk about that when we come back from the break. Don't go away. More with Danny Ratliff and myself when we come back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Davey's always saying, I can't retire. You can't. Visual Capitalist put out a graph this morning. The title of the graph is, How Much Longer Do You Have to Live? It's a very sobering graph for 6 o'clock in the morning.
The Real Investment Show podcast.
You look at this graph and then you find your age. It says, I'm going to die roughly about 78. So I've got about 18 years left on my ticker. So I'm retiring soon.
At realinvestmentadvice.com.
The sand in my hourglass is running out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talking about, narratives real quick before the break. I just headline right now on Bloomberg. Trump signs order doubling U.S. steel aluminum tariffs to 50%. Now, he'd been talking about this, but he actually signed the order for it. Now, the important thing to understand about this is that this is what we talk about when markets adapt and absorb information and they adjust for it. So think back to where we were in April. He comes out and he says, hey, we're going to institute tariffs on people, and then the markets sell off. And, we're down 10% before we got to Liberation Day. And then, of course, he shocked the world with the tariffs on Liberation Day, and then markets went down another 10%. Now we're getting news about higher tariffs on the EU, doubling the tariffs on U.S. steel imports, and the markets are up. Futures are up right now in the markets ahead of this. So the point is this is the issue with headlines, and when when the media is talking about something a lot, the markets start to adapt for it, and they look through it and they start saying, okay, yeah, I've heard that story, and this is where we're allocating capital. So this is why it's so important not to get wrapped up in headlines. So recently we've written about Paul Tudor Jones. We wrote about Stanley Druckenmiller and their views on interest rates. And we wrote just recently about Ray Dalio, who's been warning about a financial crisis ever since 2010. And of course, he was actually worrying about a depression in 1980-81. And none of that's happened, right? But, sounding these alarms, it sounds great. And like we said before, it's great for getting clicks and views and everybody else. And so Danny brought one in this morning for me. He says, Wall Street is sounding the alarm on U.S. debt. It's time. This time it's worth listening to. And this was in the Wall Street Journal. When is that today? June 3rd.
Yesterday.
That was yesterday.
That was yesterday.
So June 3rd. So what it's talking about is that Jamie Dimon has put out a warning now from J.P. Morgan. Now, look, Jamie Dimon's a big guy. CEO of the world's largest bank. Very powerful. He has been warning of crises and economic downturns for the last 15 years.
And probably about once a year or every other year.
Yeah. He comes out with some headline.
Yeah.
And again, look, he's a banker. So he is always looking at potential risk and those type of things. But again, the whole point is, as of late, is that we're getting a lot of, and I got an email from this guy yesterday completely panicking over it. It's like, oh, what does this mean? I was like, doesn't mean anything. These guys regularly say this stuff. And, he's a banker, so he's always looking out for risk, that could impact his bank, et cetera. So he makes these statements. But these things don't come to fruition. And more importantly, the more that the market hears about these things from guys like Paul Tudor Jones and Stanley Druckenmiller and Ray Dalio and Jimmy Dimon and so forth and so on, the more that they adapt to the market. And they say, okay, well, that was said. It's out there. We know what it is. We've already priced this in. We've hedged for it, whatever it is. And we're moving on. Markets are looking forward, not backwards. And so again, you've got to be really careful with all these headlines because it leads to just making really bad investment mistakes. And more importantly, if any of this is going to come to fruition, like we're going to default on our debt, which we're never going to default on our debt, right? Or if we're going to have, some type of massive economic downturn, whatever, it's not going to happen. It's not like you're going to go to bed tonight looking at the world the way it is today, and then tomorrow morning you wake up and everybody's in a bunker. That's not the way these things will work. You're going to see it show up in economic data over months of time. These things don't just happen overnight. It's like they always say, right? It happens slowly at first, then all at once. And it's because people, for instance, like the financial crisis. You go back and look at the financial crisis. We were warning about the financial crisis back in 2006, saying, hey, there's this buildup in subprime markets that is going to be problematic if certain things happen. All in 2007. We were making those same warnings. And then September the 18th of 2008, the world falls apart because of Lehman. It's like, oh, nobody saw that coming. Well, yeah, you saw it coming if you were paying attention to the data. These things don't happen overnight.
Well, you already had other large institutions fail.
Bear Stearns.
In May. And
Yeah. And the markets were declining from June all the way into September. So, you had plenty of evidence that there was something going wrong in the system. But again, we just don't, as investors, we don't really pay attention to stuff until after the fact. And then it's like, oh, well, nobody saw that coming. But yes, there are plenty of signs that things are happening that you can hedge for, manage for in your portfolios.
But then it's like, why didn't we see that coming, right? After you get all of this evidence that things have broken down.
Yeah.
And then all of a sudden, Lehman was the one that actually mattered, right?
Right.
Where you had all this other problems prior to this.
Well,
and the crazy thing, Lehman happened at the end of 2008. You get to March. What was it, October of 2008? Lehman?
Yeah,
September, October.
No, September the 18th. You don't want to know that date? Hurricane Ike. We were getting slammed by Hurricane Ike the weekend that Lehman went into bankruptcy.
Yeah. Because
I was hunkered down in an apartment trying to not
I remember where
survive.
I was. Yeah.
Yeah. So that happened in September, and then the market bottomed in March of 2009, and then the rest is history. But again, just Danny, you'll remember this because we were talking about this on the show. In 2019, Mike and I were talking about the repo crisis going on in the markets and why all this that there was warnings. And in January and February, we were writing articles and taking profits out of our portfolios because it's like, hey, this is crazy what's going on in the markets right now. we started reducing risk in our portfolios. We didn't know the pandemic was coming, but there was evidence that something was brewing, right, between the repo market and everything else. And then of course, the pandemic showed up in March of 2020.
Well, we did see a little bit of that because you saw what was happening over in China, right? And so we said, okay, where does this go, this spread? So we said, okay, let's take a little bit of exposure. In fact, let's take the international exposure off the table.
Right.
Then we thought, okay, as we start to see it actually spread, from China to, across Asia to Europe, and then their response to it, you start thinking like, oh, shoot, okay, what else do we need to reduce? So you reduce small cap, mid cap. Companies would typically have a hard time raising capital. Reduce any incidence of ownership in junk within the bond portfolio. And so you're kind of already moving with that, right? But we were already looking at, like you mentioned, with the repo issue.
Yep.
And so you start to navigate this and say, okay, what is actually happening here? And that's not all at once. It's very slowly. There's still equities in the portfolio. Now, the struggle then was portfolio performed really well compared to the markets when you get the downturn. But on the flip side, I think the challenge for many investors is the sudden change in monetary and fiscal policy was so
rapid.
It was so rapid, and it was tremendous, the size of it. And then not only from that, but then the continuation of it over and over again.
And we knew when we saw the Fed coming in that would be good for stocks, but what we didn't know at the time was the magnitude of it, and then also how it would impact. And we suspect, like you said, we kind of suspected something was going on in the market, so we started reducing these areas that were affected by the pandemic, but we didn't. Nobody knew that somebody was going to shut down the entire economy, right? That was just. And then, how long the economy is going to be shut down, all those type of factors, certainly made that a very different environment to navigate. And again, it was what was amazing is, and the one thing we didn't really count on, or didn't think, honestly, it's not count on, we just didn't even think about it, was that everybody that was sitting at home that had nothing to do, and they couldn't bet on sports anymore because all the sports venues were shut down, would turn to speculating on GameStop and other stuff in the markets, and we saw this massive rampant speculation in the market because everybody had money because everybody got checks from the government,
and you didn't have to pay your mortgage, didn't have to pay your rent, didn't have to do all the typical necessities, right?
Right.
They're like, oh, don't worry about it, which is crazy. Why send them the money if you don't have to pay it?
Exactly.
So we created that supply-demand problem, and that's where I think you go back. And what was really challenging then was I think everybody underestimated the change of psychology amongst most Americans.
Yes.
And people in general. You had the YOLO come out, right? You only live once.
And what's amazing is it still exists. I mean, and this was a whole setup. And by the way, if you need to keep a camera on Danny, like the whole time I'm talking, you just need to have him up and like a little window on the side.
Is it me falling asleep?
No. Because when he disagrees with me, he furrows his brows. It's like he gets this angry look on his face. And
well, that just means I walk around like that all day, Lance.
And then I know he's about to come with something. I'm like, so we just need to have a Danny cam.
Deep in thought. Deep in thought.
Anyway, but I was bringing this up is because that backdrop to 2020 changed dynamics for retail investors.
Yep.
And you kind of, and this is something we were just talking about coming out of the last break. One of the big changes that we've seen lately, and just since 2020, so just 2021, 2022, 2023, 2024, is retail investors no longer have a fear of missing out of the market. They have a fear of missing out on bottoms, and they are buying every dip. And so when the markets sell off, like in April, we saw some of the largest buying by retail clients on record ever, like historically. Hedge funds weren't buying it, but retails were just piling into U.S. equities, particularly in options, levered ETFs, some of the riskiest bets.
That's just a couple weeks ago.
Yeah, exactly. We'll come back and talk some more about this with Danny Ratliff, waiting for him to furl his brow. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny's always saying, I can't retire.
You can't.
Visual Capitalist put out a graph this morning. The title of the graph is, How Much Longer Do You Have to Live? It's a very sobering graph for 6 o'clock in the morning.
The Real Investment Show podcast.
You look at this graph and then you find your age. It says I'm going to die roughly about 78. So I've got about 18 years left on my ticker. So I'm retiring soon.
At realinvestmentadvice.com.
Can you bring up this magazine cover? Clip the very top of it off for me. So just talking a little bit about, the debt and all these types of stories that are coming out, these narratives. I know we cover this a lot, but it's so important because, this is what leads investors to making so many mistakes. Just whenever you're ready, Brent. Just thought I'd show you this Time magazine cover. Yes, I can move my cover and my mouse. Sorry. So this was in this Wall Street Journal article talking about, the debt with Jamie Dimon and, that, we're going to go broke because of all this. And it's a Time magazine cover. So, it obviously must be true if it's printed on Time. The problem is this cover was from 1972. And, one thing we talked, and Michael Leibowitz recently wrote an article about the demise of the dollar and showed the cover from 1968. And this is the problem with these end of the world narratives. And I've got an article coming out on Friday talking about, the Industrial Revolution and, what's happening in the U.S. now and how that solves a lot of these problems. Again, you look at these charts that people put out, and they're just showing the trajectory of debt, just going at a 45-degree line. And that's making a lot of assumptions that you don't have any economic growth. You don't have, any income coming in from other sources. Like, for instance, the CBO estimates don't include the $320 billion of income from tariffs that we've already received. And if tariffs stay there, that's a whole nother source of revenue we didn't have previously that's going to be paying down on debt. But none of that's included. Right. And if you have some exceptionally strong, if you just have stronger economic growth because of artificial intelligence, build out infrastructure, those type of things, which we've got to have. We have our electricity grid in the United States is extremely old and has to be redone at some point. And to power all the phones, the computers, the laptops, the electric cars, all this stuff, we're going to have to upgrade the power grid. That's massive infrastructure build out. And that'll have to be a public-private partnership. The government's going to have to step in, provide funding for that because it's a national security issue. And private companies will have to invest in that capital as well. So companies like Duke, American Electric Power, et cetera, they're going to be investing heavily in building out infrastructure for electricity. That all adds to economic growth. As we said yesterday, every $1 billion of infrastructure is $3 billion worth of economic growth, of economic activity. There's a multiplier effect to infrastructure. So when you start talking about 5, 6, 7, 8, 9, $10 trillion worth of spending over time to build out this stuff, the magnitude of that can elevate economic growth from 2.3 to 3%, and that solves a lot of your debt problems. So again, you've got to be careful with these big, massive narratives that the world's going broke, because it's not. And there are things that are coming on the horizon that's going to change a lot of that. Anyway, we've got an article coming out on that on Friday. We'll talk about that. Just real quick, I wanted to touch on with you, Danny, because there's a new research report talking about when following a congressional stock trade can give you an edge in the market. Well, we all know we just need to follow Nancy Pelosi, but she's kind of out of the loop now. So how have her trades been doing lately? Is she's still killing it?
Yeah, that's the funny thing. So there's an article that's out, and it's kind of, they've gone through, and a survey was actually done looking at who's in office. If Republicans control House, Senate, and presidency, they're more inclined to place trades, and vice versa, right? Obviously, if you're kind of more in the know, you're actually creating this legislation, it gives them an opportunity. In 2012, there's a bill to help kind of stop that, but we obviously know that is done nothing of the sort. So, but it's interesting. One thing that the study found was that in times like this, you're more likely to see Republicans place larger trades. And generally, I said, look, if it's a $5,000 or less trade, no big deal. But if it's $50,000 or more, there's probably legs to it. Going back to last year, if Democrats were placing a trade, they were generally much larger, so $250,000 or more that they were actually placing. And they said those trades were really, really good. And so you bring up Nancy Pelosi, but there's actually ETFs out there that actually follow these investments now.
Yeah, I believe there's one for Nancy Pelosi. Don't quote me on this, but I believe there's one for Ted Cruz also.
I think there's actually multiple out there. And so
you can subscribe to some services. Yeah.
And now, so there's a couple problems with some of this data as well, though, is that when are they actually physically reporting it? Is it a week after? Is it as it happens? Or is it on their quarterly filings? And so the time lag there can actually be, it could work in your favor in some ways, but in many instances, it'd probably work against you, because as they're creating legislation, we've got a new infrastructure bill. I know what's in this bill, what's going to happen. And, it's ridiculous, because if you and I knew this information, we wouldn't be doing what we're doing right now.
Well, and plus, if we did trade on it, we would be in prison for insider trading.
Correct. That's what I'm getting at. And so I do think there's going to be
hanging out with Martha Stewart.
Yeah.
She's out?
Yeah, she's been out for years.
I know she's been out. She's making commercials with Snoop Dogg now. Apparently, she learned how to smoke a little of the grass while she was in prison. So
you don't think that was AI?
That was all AI.
Yeah.
Yeah.
She was probably never in prison. It was all AI. But that's
she was in golf prison. Yeah. If you ever want to go to prison, do white collar crime, and you go play golf for 5 years.
Is that how that works?
Yeah, apparently. If you got money and a good lawyer.
Yeah. Man, it's like rehab for some of these people, I assume.
Correct. Alan Stanford? Yeah. He did not go to. I don't think he went to Club Fed. I'll figure. Keep going, Danny.
He was in Conroe for a long time. I know he got roughed up pretty good back in the day. But, well, and so all of these things are great, and you can utilize them. But I wouldn't put everything in one area, right? That old saying, "Don't put all of your eggs in one basket." So think about the narrative surrounding that. Now, granted, they have a lot more information that many people would pay big bucks to get to, and they do, which is why you have these lobbyists that are probably writing a lot of these bills and taking the shape of it. So it gives them the ability to go in, make these types of trades. There are ETFs out there. In fact, if you look it up, Lance, you can find, let's see.
So, by the way, Alan Stanford is serving a 110-year sentence in Coleman 2.
Where's that?
It is in Florida, and it is a high-security federal prison for male inmates. So he ain't playing golf. I got a boyfriend, but he's not playing golf.
Oh, man. So you have the Unusual Wealth Subversive Democratic EFT, tickers NANC for Nancy. You do have the Republican ETF, KRUZ for Cruz. Let's see. Those are the big ones. But who would you trust right now? If you're going to buy one, you probably buy the Cruz because
I don't know.
Slim majority. I don't know.
You know, I don't know who's. You got to be. See, you have to be in the position where you're making the laws. That was the thing that Nancy Pelosi had going for her.
Correct.
Is that she and she's just like they were all. By the way, they were all doing it.
Yeah.
Right. Like when they were passing the CHIPS Act, as an example, they were all buying NVIDIA stock. Right. And that was, remember when the CHIPS Act came out, NVIDIA was like down 90% from its peak. They were all buying NVIDIA stock at that point before the CHIPS Act came out because they knew ahead of time that, A, that bill was going to get passed and where that money was going to flow to. So, again, Nancy Pelosi is just, everybody picks on her, but she's just the most visible.
She was Speaker of the House at the time.
She was Speaker of the House, and she was very visible. And everybody was looking at her filing disclosures because her husband was basically placing the trades, and she was buying options on NVIDIA or whatever it was, and those were all public record. So that's why the ETF is able to track what she's doing because they're getting them from the public disclosures.
Well, the problem with this is that it should be put into a blind trust. Meaning they don't have any access to place any trades. No, you don't think so?
I don't think so.
What do you think?
I think if you go to work in public service where you have access to insider information, the only thing you can own is U.S. Treasuries.
Okay, I don't disagree with that.
And then once you're out, go to town.
Yeah.
And it was just like remember the Fed Reserve guy up in Dallas? Was it Fisher? Mm-hmm. Got nailed Richard Fisher. I think he got nailed. I think it was him. Don't quote me on that. Yeah. It was one of the. There was one guy in Dallas, the Dallas Fed, that got caught up in that whole thing as well because he was making a buku of money off of the stock market, but he had inside information to what the Fed was going to be doing. So again, I think if you serve in any public office where you have access to information ahead of time. And again, this is the same thing that applies to the average American, by the way. If you get inside information from your company, like for instance, you work for your company and you hear from the CFO over the water cooler that it's going to be a really bad earnings quarter because something's happened, and you go out and short the stock and that announcement has not been made public and you get caught, the SEC is going to be at your doorstep, and you'll either get fined, any gains you made will get taken away from you, and you can potentially go to jail for it, aka Martha Stewart. But see, those laws are very strict the way they apply to the average American. Why does it not apply to people serving in public office that have access to the information more so than anybody else?
Amen. I agree. Especially because they're going to know sometimes before some of these CEOs or executives do anyways.
Exactly.
It was Robert Kaplan, and he was cleared.
Thank you.
He was cleared of any suspicious trades.
Yeah, well, he had a good lawyer.
Yeah. I'm sure.
Good lawyers make all the difference.
Yep, that's absolutely right. Hey, we do have June 14th. We have our next in-person event. Go to realinvestmentadvice.com. We may have 2 or 3 seats left. It is a full house. We'd love to see you guys there. Go sign up.
There you go. And see you on the 28th for me and Danny talking about our financial summit for the half year. So, all right. See you then. It's all on the website, all the events, realinvestmentadvice.com. Have a great day.